Microsoft is now sitting on a $678 billion backlog of contracted revenue, up 84% in a single year. We are doing this video in two parts. First, I'll grade the report, then walk you through how I'd trade it. This is Microsoft, ticker MSFT, for the fourth quarter fiscal 2026. This is not financial advice. Everything in this video is just my own opinion for educational purposes only. Trading involves risk, and your results may vary. Alright, on the top line, Microsoft came in 2.73% above the estimate, which sounds modest until you realize revenue grew 18% year over year to $90 billion. At Microsoft's size, that is a huge number. And on EPS, they reported a 12.06% surprise, with earnings of $4.81 per share. But here's the catch. About 27 cents of that came from a one-time gain on their Anthropic investment. Strip that out, and the clean operational EPS was closer to $4.54, which is still a real beat, just smaller than the headline. So, on the beat itself, and I'm grading against the clean operational numbers, not the Anthropic inflated headline. This earns a B. A 3% revenue beat plus a clean high single-digit EPS beat at Microsoft's scale is genuinely strong, but not the double-digit monster the reported number suggested. And on consistency, this earns an A. Microsoft beats quarter after quarter, and this makes the streak that much longer. You can pretty much set your watch to it. First, the headline number. $90 billion in a single quarter, growing 18% year over year. At Microsoft's scale, that kind of growth is really hard to pull off, and they're doing it. On top of that, Azure grew 43%, which is actually an acceleration, and management is guiding to around 45% next quarter. They're basically telling us the AI cycle is still expanding, not slowing down. And this one is the number I can't stop thinking about. Their commercial backlog, meaning contracts they've signed but haven't recognized as revenue yet, hit $678 billion, up 84% in a year. That gives them multi-year visibility that almost no other company has. Then on the Copilot side, paid seats crossed 30 million, and net new seat adds more than doubled from the prior quarter. That's a step function, not a gradual ramp, and it tells me enterprise adoption is finally hitting its stride. And the last one is the piece that quietly answers the biggest bear case out there. They're getting 4 times the throughput on Copilot workloads, 89% cost reductions on GPU usage in Dynamics. And they're monetizing those efficiency gains right now, not banking them for later. So putting all that together, on profitability, I'm landing at a B. Operating income actually grew faster than revenue for the full year, which is impressive, but gross margins are still compressing because of all the AI infrastructure spending. Strong, just not perfect. The first thing that sticks out is gross margins. They came down to 67%, and Microsoft Cloud margins dropped to 65% because they're building out AI infrastructure faster than demand can absorb it. Management flat out said this pressure continues into next fiscal year. Then on the capital spending side, they spent $41 billion in this quarter alone, and they're guiding over $50 billion for next quarter. Free cash flow got squeezed hard because that spending is eating almost all of the cash they're generating. The consumer side keeps quietly weakening. More personal computing was down 4%. Xbox content and services down 10%, and management is guiding Windows OEM to fall in the low 20s next quarter and high teens for the full year. That's a real drag. This next one is the one I really want to flag. When an analyst asked about overcapacity risk, the CFO, Amy Hood, admitted management is reading up on the 1873 railroad bust. the classic historical example of overbuilding leading to a crash. That's an unusually honest admission that oversupply is a scenario they're actually planning for. And this last one is more of an accounting note, but it matters. They extended the useful life of data centers from 15 to 25 years, which reduces reported CapEx by about $25 billion next calendar year. The actual spending doesn't change. It just looks smaller on the income statement. So on guidance, this earns an A. The Azure acceleration to around 45% plus another year of double-digit revenue and operating income growth is a genuinely strong outlook. But on red flags, I'm landing at a C. The CapEx intensity keeps stepping up. Gross margins are still going the wrong way. And when the CFO herself is name-checking 1873, that's not something I can just wave off. Putting it all together, this was a genuinely strong quarter with real substance behind the headline. Azure is accelerating. The backlog is enormous, and Copilot is finally hitting escape velocity on enterprise adoption. But the CapEx intensity and management's own acknowledgement of overbuild risk keep me from calling this a perfect print. So the way I see it, Microsoft earns a B+ on this one. So that's my grade on the report. Now let's talk about what you actually do with it. I've broken this into 6 scenarios depending on where you stand. Whether you're looking to get in, selling cash-secured puts, holding shares, sitting on covered calls, holding leaps, or underwater, or thinking about adding, find the one that best fits your situation. Okay, let's get into it. Look, the accelerating Azure outlook and Copilot momentum are already baked into this print, so chasing it here just feels like paying top dollar for good news everyone already knows. What I want is either a broader market pullback that pumps up implied volatility or a give back of some of this post-earnings pop before I put money in. If I do sell a cash-secured put, I'm looking at strikes about 8 to 12% below the post-earnings price, and I'm targeting 30 to 45 days to expiration to give myself room for noise. Bottom line, I wait, I don't chase. The one scenario that could really break this bull setup is Azure missing the roughly 45% first quarter growth target, so my strike selection has to account for that. My floor sits around 10 to 12% below the post-print price, and I'd only sell a strike closer, like 5% below, if I genuinely wanted to get assigned for a long-term hold. Amy Hood's 1873 book comment on the call was a quiet nod to tail risk, so I size smaller and target 30 to 45 days out for flexibility. So my strike floor sits below a guidance miss. Commercial remaining performance obligations grew 84%, and Copilot showed a real step function in net seat adds, so the fundamentals are getting stronger, not weaker. Management called out 4 times Copilot throughput and an 89% GPU cost reduction in Dynamics, and those internal AI efficiency gains reinforce my multi-year thesis on the shares. The Anthropic gain added 27 cents to EPS this quarter, and I treat that as one-time noise. But the underlying operational beat was still meaningful, so I only trim if my position has drifted way above my target size. I'm holding, and I add on macro dips. The accelerating first quarter Azure outlook creates real upside risk to my near money strikes over the next 60 days, and I need enough cushion to survive a 5 to 8% move higher. So I'm looking at rolling near money covered calls up and out to strikes about 7 to 10% above the current price, and stretching out to 45 to 60 days to expiration. If I'm holding through the late October first quarter print, management basically told analysts, Azure accelerates further, so I'd probably pay the debit to close any very short-dated, at-the-money calls before that report. For me, that means rolling up and out for cushion. The commercial remaining performance obligations recognized beyond 12 months grew 112%, and Copilot economics are shifting from just per seat to seat plus consumption, which expands the total addressable market. I'd only roll my long-dated calls up and out if delta has drifted well above 0.85 and I really want to lock in gains while keeping upside exposure. The one scenario that would invalidate my long-term thesis is sustained Azure deceleration below roughly 35% growth, so I'm watching the first and second quarter fiscal 2027 prints specifically for that signal. For now, I'm holding thesis reinforced. If I'm underwater on Microsoft, this print actually validates the thesis, because the backlog, Copilot momentum, and efficiency gains all confirm the AI spending is generating returns, not destroying them. So I'd add in pieces on 3 to 5% pullbacks rather than dumping everything in at once, and let the market give me the entries. To fund the average down, I'd sell cash-secured puts at strikes about 8 to 12% below the current price, and if I'm adding to a winner, I still wait for the pullback, since the accelerating outlook is already priced in. So my plan is average down in pieces on dips. Bottom line, this print earns a B+ from me. Microsoft is still one of the highest quality names you can own, but the entry math has gotten harder because the acceleration story is already priced in. The next two prints are the ones that really matter. Thanks for watching.